It really does feel like the ground is shifting under our feet when it comes to global trade.
It does, doesn't it?
Yeah, and how things are bought and sold around the world.
Yeah.
It could hit everything from, well, the price of milk to maybe even our job security.
Absolutely.
So today, on the deep dive, we're going to try and get a clearer picture of these potential changes. We're focusing particularly on that really complex relationship between the U.S. and China.
Right. And we've been looking through, recent economic reports, policy actions, trying to pull out what really matters.
Our mission, basically, is to distill the crucial insights for you, help you understand the possible economic impacts without, drowning you in charts and numbers.
Exactly. Cut through the noise.
Okay, let's dig right in. Tariffs. U.S.-China tariffs are, well, they're still very much in play, and the U.S. administration doesn't seem to be backing down.
No, definitely not.
It's always tricky to see the exact effects, but some recent things give us clues. Like China stopped publishing its youth unemployment figures. You don't really do that unless the numbers aren't looking too good, right? Suggests some pressure, maybe.
That's often a sign, yeah. Withholding data like that usually points to some underlying economic stress. It makes you wonder.
And then you layer on how companies are saying they'll react to these tariffs.
Right, and that's revealing. We saw one analysis showing, 76% of companies plan to pass those tariff costs straight on to consumers.
Wow, 76%.
Yeah, it suggests they don't have much wiggle room, Margins might be tight, or maybe the competition is just too fierce to absorb those costs themselves. It points to a kind of vulnerability.
Which immediately makes you think, okay, inflation. If they pass it on, prices go up.
Could be a noticeable jump, yeah, if consumers absorb it.
But what if they can't or won't pay more? What does that do to the companies?
Well, that's the other side of the coin. If prices stick because people aren't buying, then companies see their profits squeezed.
Lower earnings, maybe?
Lower earnings, yeah. And that could ripple out. Maybe they cut back on investment, hiring, potentially leading to a slowdown or, worst case, a recession.
And this ties into the whole push for onshoring, bringing manufacturing back to the U.S. Sounds good on paper jobs, supply chains.
Sure, the security aspect is appealing.
But what if it just costs a lot more to make things here? Does that fix the problem or just make inflation worse?
That's the dilemma, isn't it? You might solve one problem, supply chain risk, but create another with higher costs feeding into inflation. It's a real balancing act.
Speaking of unexpected moves, did you see the Taiwanese dollar? Big jump overnight, like 5%.
Yeah, that was significant. You don't see that kind of move every day.
Not at all. What's behind something like that?
Well, there's probably a mix of things going on. Some speculation maybe that Asian countries might revalue their currencies for U.S. trade deals. That's one theory floating around.
Okay.
We're also seeing signs of, hot money, big capital inflows into Taiwan. Plus, Taiwan's own economy has had some positive data, and strong earnings from U.S. tech firms with big operations there probably helps too.
So good news locally, plus maybe some external factors.
And perhaps even a little bit of optimism, maybe premature, about U.S.-China tensions easing slightly. It's hard to pin down one single cause.
It does feel a bit precarious, though, doesn't it? The analysis we looked at even mentioned the '97 Asian crisis and long-term capital management.
Right.
That's serious stuff. Makes you realize how quickly things can get shaky.
It is. It's a stark reminder of how interconnected everything is and how volatile things can get. Market shocks can happen, and they test everyone.
Okay, let's pivot slightly. U.S. and U.K. trade. Looks like they have a sort of pre-agreement. U.S. keeps the 10% tariffs, but not on cars.
That seems to be the shape of it, yes. A carve-out for autos.
And this is happening while everyone's kind of holding their breath for potential U.S.-China talks in Switzerland. Feels like a lot is converging.
It really does. And you hear this phrase, rebalancing global trade. Fundamentally, it means consuming less, producing more at home.
Right.
And if you look back historically, U.S. manufacturing as a share of the economy, it's fallen dramatically from nearly 30% in the 50s down to around 10% now.
That's a huge shift. The analysis called it a program demolition. Pretty strong words.
It is strong language.
Yeah.
But it reflects this massive transformation tied to globalization and free trade over decades.
Which brought benefits, obviously, but also this big drop in domestic manufacturing.
Exactly. And now there's this talk, this desire to bring manufacturing back. The analysis even said made by hand, which sounds almost quaint given automation.
It does. especially when you see that only about 20% of Americans think they'd actually be better off if those old-style factory jobs came back.
And the reality is automation, right? That's where manufacturing is headed, mostly.
So how does that square with the political talk? Wanting jobs back, but maybe not the kind that exist anymore? Or not in the same way?
It's a real contradiction. You want production back, maybe under protectionism, but you still want the upsides of globalization. And then, practically, who fills those jobs, especially lower-end ones, given immigration policies? It feels a bit like trying to recapture the past.
And hanging over it all, the U.S. budget deficit. The analysis made a really interesting point about potentially reversing the petrodollar system.
Ah, yes. The idea that trying to rebalance trade could undermine that system where oil is priced in dollars, which creates demand for dollars and helps fund the U.S. deficit.
That would be a fundamental change. Huge implications.
Absolutely. Messing with the architecture that's been in place for so long, it inevitably affects how the U.S. pays its bills.
Okay, let's talk monetary policy. Fed Chair Powell.
Yeah.
Very much wait and see on rate cuts. The analysis said he used the word wait 22 times.
Something like that, yeah. The message was pretty clear. Don't pound on rate cuts in 2025. Unless
tariffs really bite the economy hard.
Exactly. And what's really interesting is the connection highlighted between trade and monetary policy. Scott Bessent, the chief U.S. trade negotiator for China, apparently has regular meetings with Powell. That suggests, a strong link. Trade moves might force the Fed's hand.
So even though we had negative GDP recently and inflation's still sticky above 2%,
right,
it seems like trade is maybe the bigger driver of policy thinking right now.
It appears that way, yeah. And the scale of this U.S.-China thing is just massive. The analysis pointed out, okay, the trade deficit is maybe $300 billion.
Which is a lot.
It is. But U.S. companies' revenues tied to China, something like $1.2 trillion.
Whoa.
It was described as the largest leveraged trade the world has ever seen. So it's not just the deficit, it's this huge web of corporate activity. Messing that up has far bigger ripples.
That really puts it in perspective. And the potential fallout, if it's mishandled, the analysis suggested big rate cuts, hundreds of basis points, maybe even more QE.
That's quantitative easing, yeah, the Fed pumping money in by buying assets.
That sounds like a pretty drastic potential response.
It highlights the risks, doesn't it? The potential for major instability if this trade relationship sours badly. The interdependence is just so vast.
Meanwhile, on China's side, they've been cutting rates themselves recently, trying to boost their economy, lowering the reserve ratio requirement, the reverse repo rate.
Right, trying to stimulate lending and activity, standard tools for them.
And the big news, Chinese Vice Premier He Lifeng is set to meet Scott Bessent in Switzerland.
That feels like a potentially pivotal meeting.
Could this be the start of something new, a new era?
It could be. It might really set the direction for future trade, maybe even touch on the dollar's global role eventually. It ties back to everything we've discussed, the tariffs, the currency movements.
Yeah.
It's all connected.
So if we try to wrap this up, we've got these ongoing U.S.-China trade frictions, this real risk of either inflation spiking or the economy slowing down.
Those surprising currency jumps.
Right. The whole backdrop of U.S. manufacturing decline, and now these crucial talks happening in Switzerland.
Yeah, it all feels very interconnected.
And the core tension seems to be this desire to, change how global trade works, bring production home.
While trying to manage the potentially very painful economic consequences of doing that.
It really leaves you wondering, how is this constant push and pull between trade policy and monetary policy going to reshape the world economy? And maybe more to the point, your own financial situation. What are the signs you'll be watching for in the coming months? That's definitely something to chew on.